All right, I'm going to get started because it's a little after 7 and Peter's not known for being brief. So, well, good evening, everybody, and thank you so much for being here. It's been fun and really great to see everybody having a good time, and thank you for coming out to support us. Before we get started with the presentation this evening, I'd like to start just by saying thank you to everybody who helped make tonight possible. And I'll start by saying thank you to all of you here in the room, our clients. We are so thankful that you place your trust in our team to be stewards of your wealth, and we value that commitment that you place in us and cannot say thank you enough for choosing us to be your trusted advisors. So thank you for being here. Second, Peter and I would like to thank our team at O'Keefe Stevens for their contributions to this evening. And the efforts that they make on a daily basis to make our business operate like a well-oiled machine. I can assure you we need them. So Marissa, Carly, who had to leave, Kristen, Dominic, and Grace, thank you for the commitment you show to us and to our clients, and we couldn't do this important work without you. And finally, say thank you to the Buffalo History Museum. This has been a great place, and Tapo, the caterer, did a great job with dinner. So thank you for creating such a wonderful experience tonight. And last, I'll say thank you to Paul and Chelsea with North Glow Photography for capturing this evening in photo and video. And thank you for those of you who volunteered to be on the video. I can't wait to see the incredible product that you two always put together. The format for this evening is intended to be conversational. We'll be conducting open Q&A, and I have several prepared questions and some pre-submitted questions, but please feel free to raise your hand. Grace has a microphone, so if you flag Grace down, she'll bring the microphone over, and I'll call on you when we're done answering the previous question. Before we jump into those questions, I just want to introduce our two speakers tonight with a quick background. I'm sure many of you know a lot more about Peter, but I see 3 generations of clients when I look into the audience today, and I know that we have started working with the 4th generation of many of your families. The reason we're all here goes back to the 1980s when Peter O'Keefe began his career here in Buffalo at Truby Collins. For nearly 44 years, Peter has embodied what it means to be a financial steward. And that high integrity approach and the personal approach to financial planning is what's defined his career. And it's the reason that we're all here and fortunate to work with you and your families and future generations. So I've been fortunate to call Peter my mentor for the past 15 years and my business partner for the last 12. And we made the decision to branch out and form O'Keefe Stevens Advisory 7 years ago, almost to the date, 7 years ago. We had the opportunity to start with a clean slate and to design a business and service model to be something that's unique and representative of who we are. Something that demonstrates what we stand for and what we believe. And along the way, we've grown our team to include some other outstanding professionals who share those beliefs and the dedication to our clients. So our other speaker tonight is Dominic D'Angelo, who joined us 3 years ago. Similar to Peter, Dominic grew up in Buffalo and attended Canisius College. What you might not know about Dominic is that before he joined our firm, he had been in contact with us for many years, probably three years prior. And we didn't have a spot for Dom when he first started reaching out to us, but he stayed in contact. He listened to our calls, he read our newsletters, he reached out to Peter and I on a regular basis, and along the way in between college and joining up with us, Dom had opportunities to work as a real estate analyst, an equity analyst at one of the largest pension funds in the United States, and for a hedge fund. And he's been with us for 3 years now and has become a meaningful contributor to our research program, which continues to improve every year. Peter and Dominic, is there anything you'd like to say before I begin with the questions this evening?
Yeah. I just want to say it's really been a pleasure to work with Sioux folks, many of them going back almost 40 years, some maybe even 40 years. And I've always operated on a very simple principle, is that to always act in your best interest and let the chips fall where they may. Because I'm capable of making an awful lot of errors, and as you know, I've made them. But when you act in someone's best interest, things usually work out. And as I look out in the audience, I see a young man and a young woman whose mom had died, and there was a fundraising charity where they raised $10,000 for each of them. And the son hasn't touched that account, and he can buy himself a mansion with what his account looks like today, and he's buying a house next year. My buddies from college are here, and you know they have a chance to see how you work in college, and so it's been just an absolute blessing. And as I look back here, I see my life unfolding with just the great relationships that I have. And many of you, I just look at it and say, that's how you do retirement. And when I look back and I see the Browns, that's the one that jumps out at me. And I see that now with Justin's parents. You know, when you accumulate wealth, you don't just accumulate it for the heck of it, you accumulate it to make it work for you. And it's a beauty when you see that in action. So, thank you.
The only thing I'll say is the one position Justin didn't mention was I was a professor at Nazareth about a year ago, and just like all the students, nobody would sit in the front row, and I guess that's similar here, so.
He doesn't have any projectiles to throw if somebody falls asleep, though, so we shouldn't serve turkey for dinner. Well, why don't we start? I'll start the first question, but please, if you're compelled to ask, please raise your hand, and Grace will bring the microphone over. Why don't you two talk a little bit first about the things that we've done this past year to improve our investment research?
Why don't we start with you?
Sure. Yeah, I think one of the things that really differentiates O'Keefe Stevens versus any of the previous firms I've worked at is just the learning that these guys put at the forefront is one of the most important parts of our day-to-day lives. So from the research side, when I started, one of the few things we did, or I guess didn't do, was we wouldn't really talk to management teams or the investor relations. So any public company, they typically have a few individuals dedicated to talk with investors. And one of the things we've done this year is we've talked to some of the management teams, some of the investor relations. Peter, and Justin all talked to the management team at 5 Point Holdings. I recently got off a call with the management team at BGC Group. So when you're going into business and you're investing in these companies, one of the things I've tried to bring forward is, you know, we are partnering with the management team. We want to learn a little bit more about them, how they're thinking about capital allocation, where they see the business. So talking to management more often, I think has been one part of it. And then second, I've taken a couple classes over the past year, and then going forward, I've got a bunch of travel lined up. I've got a networking and just meet up in New York next week. I've got a conference in Dallas in November, and then Peter and I are going to the CES conference in January. We'll see NVIDIA speak, Qualcomm speak, I'm sure a bunch of other companies that we have. So really trying to get out on the road and meet with our companies, just see what they're seeing in real time.
CES is the Consumer Electronics Show in Las Vegas, which we've never been to, so we're looking forward to that. We also this year, I've been to the Berkshire Hathaway annual meeting, which is just an incredible classroom opportunity with listening to Warren Buffett and Charlie Munger, probably the two premier minds of investing. And but they're not the only ones that that we admire and learn from. Marty Whitman, I just love the way that man thought, and to have had the opportunity to actually meet with him has been an incredible blessing. And also when we go out to Las Vegas, we're going to go to the Sphere, which is one of our newer investments that we made. I think our first investment was in June of this year. It recently opened up with the U2 concert, I think on the 30th of September. So it's been getting some little bit of publicity on the television in recent days. There's an old Indian statement saying, and my wife is Native American, but I embraced this long before I ever met my wife. It's as long as I shall live, I'm going to learn how to live. So I'm a student of life, and I'm committed to that. And I don't know any other way. I mean, life presents us with a wonderful opportunity to learn, and that's what my life is about. I don't even drive a car. I drive a university on wheels. So when I drive my car here, I'm listening to a book or a tape or something of that nature that's hopefully something that's going to stick with me and make me a better person than I was yesterday.
Thank you. Let's talk about investment themes that we currently have in the portfolio. Any particular themes that you'd like to share?
I can start. So one thing you may notice is we own a couple, housing-related companies, whether it's Tri Pointe Homes, Green First, Weyerhaeuser. If you look at any study, the U.S. is underbuilt by about 3 to 4 million homes. And if you look at the transactions that are going on right now, I'm going to say over half, it might be closer to 70% of homes right now are the initial transaction is actually a first time is a new build, not a buy and sell between an existing home. And obviously one reason for that is higher interest rates. When you have a mortgage of 3%, your propensity to move is far less than if it's a 6, 7, or 8% interest rate. So one of the things that we've been purchasing, Green First, Weyerhaeuser, Tri Pointe, that all builds on that theme of the U.S. is substantially underbuilt over the past decade. We think at some point that gap needs to close, and these companies should benefit over the long run.
Another theme I'd like to focus on is wireless. The world is going wireless. A number of you owned Qualcomm when we first purchased it in 1998, and we had a 25-fold increase in less than a year and sold that position. We were able to buy that position back at a 25% discount from where we sold it 17 years later. And of course, at that time, they had a number of issues, but those issues have all been resolved, and the world is going wireless. It's not just going to be cell phones. Everything's going to be connected. The watch is going to be connected. If you have some sort of pacemaker, that's going to be connected. The factory floor is going to be connected. The world is going wireless, and we own the premier company in wireless in Qualcomm. And so we're just really, really excited and well-positioned with that as we move forward. And I'm not talking about over the next year. I'm talking really over the next 10, 15 years. It's going to be absolutely miraculous what happens. 5G is 100 times more powerful than 4G. 3G brought us the smartphone. 4G brought us the apps and things of that nature. I don't know what in the world 5G is going to bring us, but everyone in this room who wants to become a broadcaster is going to be able to do it, and you already can do it with 5G, but it's going to be so much more than that. Tom, any other?
I guess the other one, building on a relatively recent purchase, is just we've all seen kind of what the move in interest rates has been over the past year and a half, and we've gone from, call it a 0% interest rate environment to 10-year treasury somewhere around 4.5% to 5%. Companies like M&T Bank, Bank of Ireland, BGC Group, all of these companies are going to be major beneficiaries of higher rates. BGC in particular, one of the things, if you follow the Twitter account, is we've had rates at 0% for the past decade. Nobody really has an understanding of how profitable this company can be, and they are just starting to show early signs of the profitability and the revenue growth. The company in the first quarter of this year grew revenues by 13%. This upcoming quarter, they think they're going to grow revenues by a similar amount. I think we are in the very early stages of seeing this company grow revenues I can see them potentially doubling revenues over the next 3 to 5 years, and I'll just say the market is nowhere near expecting that kind of result, which should bode well for that investment in particular.
Great. Any questions out there? It's okay, I got more. You talked about the interest rate environment and how that's changed over the last 2 years. We've also been in a low inflation environment for an extended period of time before the recent surge in inflation over these last 2 years. How does this impact the portfolio, and are there any stocks that you think will benefit from a higher inflationary environment?
Many of us have lived through the 1970s and the highly inflationary environment that we had there. We have some similar scenarios that have taken place. And with the financial crisis in 2008, 2009, the government poured a tremendous amount of resources into the economy. During COVID, the government did likewise, and I think those were positive things, but there's a price you pay for the government pumping that type of money into an economy. We've pumped in so much money into our economy. It's like it's like after World War II, after a tremendous war. There's a price to be paid for being fiscally irresponsible, and where you pay for that with inflation. So there's no politician that has to say, I'm the one who's responsible for this, okay? It's been going on for so long that it's time to pay the piper. And we had 9% inflation a year or so ago. We have companies like Stepan Chemical and Corning that increased their prices 26 and 30%. They're not going to roll back those prices. And when you go and buy Tide, they have to buy surfactants that are the basic ingredient that Stepan makes. And we're going to be paying higher prices in that moving forward. So we want to have you positioned to benefit when that happens. And owning equities is one of the key ways in which to do that, because companies have the ability to change their prices as their costs go up. But if we have you locked in to a U.S. Treasury note for 30 years at 3%, it's your income stream and your money. Your income stream is not going to grow, and your money's going to be shrinking with inflation. So we want to own equities that are going to allow us to have a growing income stream and to appreciate in value.
Yeah, I'll just build on that. One thing that really differentiates what we do relative to the traditional investment advisor, you probably all heard of the 60-40 portfolio, 60% equities, 40% bonds. Bonds, I looked at what long duration bonds, so just 20-year treasuries have done, and there's an ETF called the TLT, and if you had owned that over the past 10 years, and the way it worked, they just pay out all the interest that the U.S. Treasury pays out in dividends. But if you reinvested those dividends over the past 10 years, your cumulative return over the past decade would be 7%. So if you invested $10,000 10 years ago, it would be worth right around $10,700 today. If you think about what inflation's done over the past 10 years, you're probably 40 to 50% behind in terms of what your money can buy today relative to where it was back then. So I agree with Pete. The only way to surely protect your money and your capital is equities is the primary way. And we all see the prices at grocery stores, what those have done. But behind that is, if you think about, companies that we own are Warrior Met, GrafTech, industrial companies. If you think about the cost to sort of rebuild these plants or bring on a new mine, everything is just costing more and more these days, which if you own a commodity company in general, that means the commodity now has to be at a higher price for companies to justify reinvesting back into the business or opening up new mines or new plants. So, we see, again, GrafTech, price of graphite electrodes over the long run are likely to increase because the cost of bringing on a new graphite electrode manufacturing plant is going to cost more over the long run.
Great. Any questions? That's all right.
Well, let me just comment a little bit. Even though our portfolio is heavily weighted at the moment towards equities, we've had periods of time where we own significant amount of U.S. Treasuries and things where we felt that the risk was there. Many times people look at equities and they see risk associated with that. But, you know, if you look at our core beliefs, the number one thing that we look at and are concerned with is risk. So, but risk comes in many, many shapes and forms. So, you know, when you own a business, if it's highly leveraged, you have a tremendous amount of risk of that business having to be recapitalized if they can't make the payments on those bonds, or they have to refinance those bonds at higher and higher interest rates as interest rates rise. So while we own equities, we're very, very concerned about the risk, and we want risk to be hopefully as low as possible when we're purchasing. But risk and return are not opposites. You can have a very conservative investment without a lot of risk and still get a good return on it. And that's what Dominic and I spend our time, and Dominic spends a lot more time at it than I do because that's his entire focus. And that's one of the beauties of what's happened over the last several years is Dominic is 24/7, 365 involved in research. And my time is split in 15 different directions. The relationships I have with individuals and talking to you and stuff of that nature. While I'm doing that, I'm not researching XYZ Corporation. So he's just a huge, huge addition moving forward to us as a business as I see it.
Why don't you, oh yeah,
I'll get a question for you.
all right.
Very good. Pete, you mentioned 2008 and the housing issues and stuff that took place. And, you know, we have a position with the Fannie Mae organization, the American Conservative Conservatorship, if I'm not mistaken still, with the government. How long do you see that going on for? Because you had said earlier, you know, we're in it for the long haul, which I get. But is it, and in that, we saw the price of those instruments go from, you know, some of them were at $10, and then, you know, now they're down to almost 50 cents, which isn't a problem, but we know it's coming back. Do we have an idea when? I mean, it's all speculation, but based on what you're seeing in the, you know, the government and what they, you know, lobbing about.
Fannie Mae is probably, from a performance standpoint, the worst investment that we've made in the past 10 years. It's interesting that it coincides with our investment in NVIDIA 10 years ago, which is up 100 and some times that. Fannie Mae is a fabulous business. It's critical. They literally are the insurance for folks making their payments on their mortgages. We can buy that entire business, including the 80% that the government owns today, for about $3 billion. Last year, they made about $20 billion. So we can still own that business for an absolute fraction. Getting out of that conservatorship is the key. In answer to your question, I have no friggin' idea when that's going to end. I thought it would end 6 or 7 years ago, to be honest with you. But if you said to me, Peter, what do you think one of the absolute best investments out there today is, I would say both Fannie Mae and on a more conservative level, the Fannie Mae preferred stock. Because ultimately, they're going to have to deal with us. And they're going to have to open up the cash register. And I think we're going to do very well with that investment, although it's been a friggin' disaster for the last 10 years.
I remember when we purchased that investment, and you mentioned it was a similar time frame with NVIDIA. And the funny part about that juxtaposition is the conviction piece that we had in Fannie Mae, I would say was much higher because it was such a screaming bargain compared to what we were buying and what we were paying for it. And when we shook hands on that investment, we agreed that the real price we would pay was patience, not money, because it was trading for like pennies on the dollar. And Peter's absolutely right. I mean, it's unheard of to buy a company at a fraction of their earnings. And so the facts are very much on our side there, but the way that the world works, it could take a very long time. So if we look position size-wise, and Dominic maybe chime in on this, it's still a very small portion of the portfolio, namely because other things have risen up around it. But at this point, I mean, we're looking, Peter mentioned risk, we're looking for asymmetric risk, where the likelihood of it going down to 0 is there, but the likelihood of it going to 25 is also there. And we like those odds. That's a good value proposition as an investor. So maybe you can comment on position size.
Yeah, I think Joel Greenblatt, he's an investor that I followed for a couple of years. He usually sized his positions not based on which one had the most upside, but actually which one had the least amount of downside. So when we think of Fannie Mae, we know that the preferreds, if we get paid out par, it's got about a 10x upside from here, and you've got obviously maybe a 0, but highly unlikely. So even if we position it as a small position in the portfolio, and we're right, that is still going to have a meaningful impact on the overall return and results of the portfolio. With regards to your time frame question, I would say there's a small bet on, in 2024 when we have the election, that will probably affect the time frame of when this could get resolved one way or the other. And then I'll just say one other thing that is an interesting development over the past year and a half with the rise in interest rates. When I came here, my initial assumption was we're going to get paid out par, the $25, because they're going to have to refinance or basically pay off par, the preferreds, and then probably issue new ones. With the move in interest rates, the rate at which Fannie Mae can probably issue new preferred stock is actually probably pretty close to the rate at which the preferreds that we own would pay out on. So if you think about it, we're buying, call it a $2, maybe $3, all depends on where your cost basis is. But that yield would be somewhere around, I'll just make it easy, $1.50 to $2 in dividends. If they do not refinance and pay off those preferreds, we're looking at anywhere between a potential 50 to 100% yield on our initial cost if they just start reinstating the dividends, which I think could be a material upside to the position that maybe we haven't talked about in the past.
Well, I know there is a lot of, I call it noise in the stuff I was reading, because all they were doing was they were trying to get people to say, well, this is a good investment, when they weren't, there was no substantial evidence that they were going to remove the conservatorship. And as a result of that, that inflated the price, because I thought it was all emotion. It didn't mean anything, as I was watching it. And then, then when COVID hit, and everything else, like the way everything goes. But it's an interesting story, and I know it's been, as Peter said, billions of dollars is coming into this organization that the government's holding back. We have no control over that here as investors, but it's interesting to hear your insight on where it's going, and, in the time frame, hopefully I have time. I expect to have time, I don't,
Right.
It's interesting that what's going to resolve that is a political or legal solution. And, when there's a lawsuit and stuff of that nature, people very often run and hide away from that. But it turns out that many of our greatest investments that we've experienced as an organization have been because of settlements and lawsuits. When Qualcomm went from 50 cents to 800, or $52 to 800 in 1 year, and back in the year 1999, it was their settlement of a lawsuit with Ericsson that drove that up. With Qualcomm, the government issued an antitrust suit saying they were a monopoly. And then a year after that lawsuit came about, Judge Judy Koh in California says, not only are you a monopoly, but your business model is illegal. Apple stops paying royalties. Huawei stops paying royalties. Well, a higher court reversed that, and then the Supreme Court decided, they decided not to bring it to the Supreme Court, so it was decided that they are not a monopoly, that their business model is not illegal. Apple paid them $5 billion in past royalties and signed a long-term contract and recently extended that. Huawei paid them $1.8 billion, and two or 3 years ago, 5G just came about. Now, 5G, it's got about 20-some versions, and we're like in version 1 or 2. It's in its infancy, because if you look at your phone and you say, I can't tell the difference between 4G and 5G. Well, after version 15 is in, you will be able to.
Steve?
Comment on corporate malfeasance, greed, CFOs, board of directors, and what do you look for and how quickly you move on from the level C?
You want to take that one?
Sure. I guess it goes hand in hand with talking to management more, but the capital allocation, the decisions that management is making on a quarter-to-quarter, year-to-year basis, if that does not align with where we think the business should go, we have no trouble passing on it immediately. The last thing we want to do is get into bed with, somebody that we think is going to make acquisitions at horrible prices, destroy shareholder value. There's so many stocks out there, so many companies run by great individuals that have great prospects. Sure, maybe 1 out of every 10 that we pass on could go on and be a great investment, but there's no called strikes in investing, and we have no problem passing on a company if the management team is just not up to what we're looking for. In terms of what we're looking for, if they're going out making acquisitions in an industry that's highly valued or highly priced, might be a warning sign that they're just trying to grow for the sake of growing. If they're expanding their business lines into things that don't seem to have any complementary benefits to each other, that would be another thing. So, in general, everything we're looking for is for a good story, cohesive, and relatively simple to understand.
I'd like to maybe add a little bit to that from a totally kind of a different approach. Several years ago, we looked at Intel, and they had free cash flows of about $20 billion, and the stock was trading at about 5 or 6 times free cash flow, and we said, this really looks attractive. This is a wonderful, wonderful business that has 60% market share, and so we made a purchase in Intel, and we wanted them to, we felt that their management team had made several mistakes, and they brought in Pat Gesslinger, who had previously been the chief technology officer at Intel a number of years ago, and what was the company he was running? VMware, and had done a fabulous job there. So we were more than happy to be aligned with Pat. After listening to a couple of his calls, and we said, well, he's got a great track record in the past, but this guy sounds like a friggin' drunken sailor. And we decided to leave Intel and take a loss on it and move away from it, because we just didn't feel comfortable that the assumptions and things of that nature, that he was being straightforward with us. And if you don't believe that the management team is being straightforward with you, you can't own it.
Maybe we could talk about broader overall market outlook. Where do you believe we are in the market cycle currently?
All right, I'll take it. So one of the areas of exposure we have to is to the consumer. So obviously through banks, you've got credit risk, consumer spending that drives a majority of this economy. So you had student debt repayments restart at the beginning of this month. You've got higher interest rates, so that's going to lower the disposable income for those that have higher mortgage rates. You know, the free handouts that the government had over the past year or two, those are gone. And credit card balances, I think I put in the last newsletter, surpassed $1 trillion for the first time. You know, the consumer at this point, I think all the headlines might say that the consumer's strong. I would say I'm getting a little worried. I think they've exhausted a lot of their savings, and now you start up, you know, some payments that maybe they didn't have in the past. You know, if you look at companies like Bolero that we looked at, Dave & Buster's, any of the companies that are more discretionary purchases, they're seeing traffic at these places down quite a bit, 10, 15, 20% relative to where they were a year or so ago. So I think, you know, again, I put in the newsletter, this quarter is going to be pretty telling on what management's talking about in terms of their outlook. How are they seeing business trends? Is traffic, you know, remaining stable, or, you know, is it sort of softening over the past couple months? So I would say my guess is if we're in a 9-inning ball game, maybe we're at the top of the 7th, somewhere around there, top of the 7th, bottom of the 7th, somewhere around there is sort of my guess.
I would add to that it's, you're talking at a 25,000 foot view. If you break it down, it happens in different, the temperature in the market is different in different places. And it can go anywhere from depression to euphoria. Okay, now if you want to talk about artificial intelligence, we're in the euphoria phase. And, you know, our position in NVIDIA, which we've been moving out of that through stock options as well as sales, you know, I just went into the office yesterday and I got a report from NVIDIA of the insider selling. And I can't come across everything from Jensen to any of the top management or the directors that aren't selling. And they're selling gobs. The 144 report on Jensen, he was selling $117 million worth of it. So in that case, we've got an article that I wrote and we sent out to everyone, but you can get copies of my view of what's happened in the past 10 years on NVIDIA. We're in the euphoria phase. But in other areas, we're in the doldrums. Don mentioned BCG, and that is on the other end of the spectrum. It's unloved, it's unwanted, and misunderstood. So one's here, one's here. So it's literally all over the place. So it depends on where you're looking. But I'm more focused on individual companies as opposed to what's going on out in the world of things that I have no control over. But we certainly want to be kind of aware of, you know, is the world being irresponsible, or are they being, or, you know, and Dom's probably, his number of 7 is probably a pretty accurate depiction of things at a 25,000 foot view.
Just one thing I'll add is, one of our favorite things though is when a market or the economy is going through a downturn and our companies have clean balance sheets, you know, positive cash versus how much debt they have. If we have businesses that are able to reinvest back in the business through these downturns, when they come out, when the market recovers, the economy recovers, these positions typically are in much better shape. They are going to take more market share from competition. So actually, when there is a downturn, assuming our companies are acting as good stewards with capital, it could actually be a benefit to the stock and the business over a long run.
Great. Why don't we talk about some of the positions in the portfolio that have declined since we made our initial purchase? Can you just give us an update on what's happening? And I'll say, Peter, why don't you talk about Warner Brothers Discovery, and then Dom, you can follow up with GrafTech.
Probably we talk about 5 Point Holdings as well.
You can talk about that.
Okay. What was the one you mentioned you want me to talk about?
Warner Brothers.
Warner Brothers, okay. Warner Brothers was an interesting situation for us. We had originally came into owning that in, probably about 6 or 7 years ago, and just after they had acquired a business. Scripps, and they did a fabulous job of integrating that business into their business, and a lot of synergies and things of that nature. And we bought it initially at about $20. Along comes COVID, and the stock drops down to the 15, 16 area, and we're loving life, and we're continue to buy this security. And all through the COVID period, up from March through November, we would have our meetings on the investments, and I would say, I can't understand why Warner is so inexpensive. I can't understand. But I continue to buy this thing. So then comes along, and now we're in March of late February, early March, and the stock price just keeps on climbing, and it's up into the $50-some area, up from 15. And I'm saying to my team, I can't understand why the thing is so high. What's going on here? And then I look at the management team, and I saw that they're selling the stock hand over fist. And it turned out, what was the name of the hedge fund?
Archegos.
Archegos hedge fund has been leveraging into and buying the stock and driving the price up. So we sold out of that position at $53 a share, okay? And then Archegos blows up, and the stock drops like a rocket, and it's now trading at about $33. And we tripled our money on it, and I thought at 33 sounds like a very attractive situation, so we repurchased our position. And then about a month later, they announced that they were going to take over the assets of Warner from AT&T, and AT&T was going to own about 70% of that business. And that merger was completed about a year later, but almost all the folks who owned AT&T had no interest in owning Warner and sold their stock, and that stock has gone all the way down to about $10 per share. And and there's been a number of issues of integrating things of that nature. The long-term prognosis for that business looks outstanding. We have a number of clients that have very big gains from their NVIDIA sales earlier this year. So we've been balancing off some of that by taking losses in Warner, but we would plan to buying that stock back before year end. Anything you'd like to add?
The other thing I'll say is, I think if you ask the management team when they made that Warner Media asset, if they could go back, do they think the price that they paid, is it fair, high, low? I bet that they would admit that they overpaid a little for the assets. But one of the things that they did when they acquired it was they locked in debt, in some instances up to 30 years, at 4-5% interest rates. Whereas if they had to go out into the market today, that debt would probably be somewhere around 8, 9, 10% interest rate. So on the one hand, while they might have overpaid a little for the assets, the financing that they got a part of that transaction actually makes it pretty attractive. So in the end, I think it looks like Paramount, Netflix, all of these guys are getting a lot more rational in their pricing, meaning the content spend that they're doing on a yearly basis is going down, and it looks like that they're taking prices. Over the past decade, the consumer has been a major beneficiary of low interest rates, such that the likes of Netflix, Paramount, HBO, they've been able to sort of undercharge relative to what they could actually get. Now we're seeing everybody in the industry sort of be more rational, increase prices, and geared more towards profitability rather than just eyeballs or subscribers, which were the main focus over the past several years. So I'll talk about GrafTech. That's one we've owned for a couple of years now, and some things that have happened there are, I would almost say, unimaginable. They got shut down. Their Mexico plant got shut down by the government. Looked like they wanted some sort of bribe to reopen that. And I think about a month or two after that event happened, Peter and I got on a call with the investor relations team, and I don't think the CFO or CEO was on it, but we asked, what's going on? Can you give us any indication? And without saying that the government wanted money from GrafTech, they basically said the government wanted money from GrafTech to reopen the plant. All of the allegations that they laid out, some sort of environmental problem, they were all lies. And GrafTech stayed course. They said that they're not going to pay a dime. So they've had that headwind. The CEO, they went through I think 2 CEO transitions since we've owned it. One stepped down, that was from the Brookfield asset, previous ownership. Then a new one came in, and he just left about a month ago. The one thing I'll say is, in similar to the commodities, the price of graphite electrodes, where they are today, it's somewhere around $5,500, $5,600 per metric ton. If you were to go over the past decade, the average price of a graphite electrode, it would be somewhere around $4,500. So even in a market in Europe that's very weak, the US steel production is very weak, we are still seeing prices that are 20% higher than the long-run average, which should tell us something about when everything starts to recover, what the potential pricing is for those graphite electrodes. The other thing that they talked about recently, and part of our thesis was GrafTech is vertically integrated with the key raw material that they need to make graphite electrodes, and that's needle coke. And needle coke goes also into the batteries of electric vehicles. They go into the anodes of it. And on the last call that GrafTech had, they talked about potentially doing sort of what I interpreted as a joint venture, and they're going to expand the production capacity of needle coke. So while on the one hand, graphite electrodes might be bad, we all can see the trend towards electric vehicles over the next decade, that the demand for needle coke should continue to increase. And that was very reassuring to see management take proactive steps to sort of limit the potential headwinds that they're facing on the steel side.
Thanks. I have a more broad financial planning question. If I'm approaching retirement, should we be changing how we allocate our portfolio? And does that mean adding more bonds or annuities?
With the rise in interest rates, bonds are becoming more attractive and are starting to approach more like equity type returns. So with higher interest rates, it does make bonds start to look more attractive. But we've stayed away from bonds for quite a long time. But we were very active in the 80s and 90s with owning equities as a big portion of clients' portfolio, or a significant client's part of their portfolio. In particular, I am not a fan of annuities. I actually have an article that I've written, it's over here, on why we're not big fans of annuities. And it's mostly because the annuity, there's a lot of things you don't have control of, and there also the cost associated with is pretty outrageous. And we had a client who came to us 30 years ago who was about 60 at the time, and his choice was an annuity versus putting money into an IRA. And we fast forward 30 years. Unbeknownst to us a few years ago, he had kept track of all the income he had taken out of his account and what the account value was worth. And if he had stayed with the annuity, it would have paid him $1,440 a month, or about $16,800 a year. And his $300,000 would have given him somewhere in the range of about $600,000 so far. But unfortunately, at his death, that will disappear. Instead, we put it into his investment account. Last year, his required minimum distribution was over $200,000. He's taken out over $1.5 million, and his account is worth about $2.6 million today. So we're talking about 4 million compared to 600,000. It just goes to show you how god-awful annuities can be. And almost all of us own an annuity, okay? If we're a teacher and we have a pension, that's an annuity. If you have getting Social Security, that's an annuity. And so all of us are familiar with owning annuities, and it's an important part of folks' situation where you have this kind of a guarantee. But the part of your wealth that we're managing is the part where we don't want the guarantees, where we want to have a rising and growing income stream so that we can outpace inflation and build wealth for both for yourself and for the next generation. And as I look out at this audience, I can see it all over the place of the phenomenal scenario that's happened with individuals. And by the way, the difference between that annuity was a 5% growth rate versus about a 10 or 11% growth rate. But what happens when you do a 5% growth rate versus an 11% growth rate for 30 years? You get 600,000 versus 4 million. And as a responsible steward, which I hope I am for you folks, I know which one I'm going to swing for.
Another kind of financial planning question. What plans and strategies and timing should a person do to protect themselves from estate taxes in the future?
We'll let you answer that question.
I thought you might. There's one strategy, but we haven't mastered it yet. Yeah. So as far as planning and strategies, this is exactly what our team is here for in terms of mapping it out. And it's a very individual and personal conversation. Many of us in the room have been benefactors of some truly outstanding investment results, and there are some key milestones to keep in mind. They're state-specific milestones, but in New York State, for instance, $6 million is the threshold where we start to look and say, there's some pretty big taxes coming up at your estate. If we cross over that mark, and that mark gets adjusted each year, but at that mark, we want to start doing some more advanced legal work. And the reason is, in New York State, they go back to $0 to assess the estate tax. So it's called a regressive tax. It's not the money over the mark that gets taxed, it's all of it back to $1. So some of the things that we look to do in those situations are partner with capable estate attorneys, which we have several to recommend, to do trust planning, and maybe even some gifting strategies, which I know many of you and some of you have been the benefactors of. So other things a person should do to protect themselves from estate taxes are, I think, review those plans every 5 years. You may not need to make any changes to your estate plan in each of those 5-year meetings, but the laws are very dynamic, and we have a big change coming up in 2026 where taxes are set to revert back to some prior year numbers. I can assure you they're not going to be those numbers, and we're going to have a lot of people who spend a lot of time thinking about what they will be, and we're going to just wait and see what they are. But when those milestones happen, it's always good to pull up another meeting with your estate attorney, talk with your financial advisors, and go through those new laws and see how they might impact you. And with an estate plan, if you live in retirement from 60 to 90, you may have to adjust that plan 2 or 3 times because of the growth of your wealth, but also the change of the laws. So there's a lot that can be done, but it's very specific based on where you are in your life and what's going on in the world at that time.
Justin, you're going to be a guest speaker at a event that focuses on that. Why don't you tell the audience?
Yeah, I think many people might have gotten an invitation, and I'll send another one out. It's at the Genesee Country Village Museum, which is in Mumford, New York. It's about an hour from here, about Building Your Legacy is what it's called. And I'm presenting with another estate attorney at the end of October. It's a Sunday afternoon from 4 to 6 at the Genesee Country Village Museum. So if you flag me down afterwards, I didn't bring any invitations, but I'm happy to send one to you if you're interested in that. This was another financial planning question, is if you were a young person starting out, what would you do with your savings today? I'm going to ask that to Peter. You can answer next.
The number one thing I would do is, I would advise a younger person is the Roth IRA. It will grow tax-free for the rest of your life. And when you're in your low years of your earnings, you should want to put as much of your 401k, if not all of it, into the Roth portion, and invest that with a long-term perspective. The power of that Roth IRA, it is a sweet, sweet scenario for the 22-year-old or 25-year-old or 30-year-old who's socking money away in that so that would be what I would recommend. Tom, what are your thoughts?
I would agree, and saving is one part, but what you do with that money when it's in that account is the other thing. You know, if you're not somebody who is actively involved in the markets or has some clues on what you're doing, I think low-cost ETFs are a great way to just start building out a retirement account. Obviously, we do it a little different here, but that's sort of our job. So I think, low, S&P 500, Vanguard funds, those are excellent vehicles to start off.
Now, as you fast forward in your career, in your 40s or 50s, and your income get extremely high, then you switch your 401k into the traditional, and you get a tax deduction. And now we are into your retirement years, and we want to do something that's going to cost a significant amount of money, and we get to say, well, where are we going to get the money from? Well, we can get it from your bank account and your cash assets. We can get it from the Roth. We can get it from the traditional IRA. We can get it from home equity line of credit. We want you to have a lot of options available to you so that we can be of guidance to you in making some terrific decisions. We want, for the younger person, we want the Roth IRA to be a very, very important piece of that puzzle that many of us in this room really did not have the opportunity to benefit from the Roth IRA, but the next generation certainly can.
I got time for one more question, or I got a little fun activity. Any other questions? This is a Know Your Investor. Oh, there is one.
Did Ira Roth play baseball for the Chicago Cubs? Ira Roth.
I think he was a senator from Texas, if I'm not mistaken, but whether he played professional sports, I have no idea.
That was a good one to end on. All right, I got a little rapid fire question round for both of you. These are one-word answers, by the way, unless you are very compelled to use 2 words. You're each going to answer. I'm going to let Dominic go first and you go second.
Okay.
I have 10. Favorite hobby?
Golfing.
Reading.
Favorite Bills player?
Mario Williams.
Josh.
Who wins a title first, the Bills or the Sabres?
The Sabres.
Bills.
Favorite investment of all time?
Go ahead, Pete.
NVIDIA.
One that was previous, but it was AirCell. It was I'll just give like 2 seconds. When markets go awry, crazy things can happen. In this company, you could buy it for $8. It was either going to liquidate for $10 the next day, or you were going to own a company that was probably worth 14 to 16. So I could buy it at 8. At worst, I was going to do is $10 the next day. So that was pretty good.
Favorite investor?
Joel Greenblatt.
Marty Whitman.
Something we don't know about you.
I have won 300 in bowling.
Who's a college bowler? Follow that one, Pete.
Some of you may know this.
I'm glad I'm asking the
I've gone
questions.
skydiving.
Wow. I didn't know that.
Favorite vacation spot?
Jamaica, but it's for the food.
Amelia Island, Florida.
Favorite food?
Jerk chicken?
It's a real easy one for me. Nothing's even close. Fresh squeezed orange juice.
Favorite book?
Fooling some of the people all the time.
Common Stocks, Uncommon Profits. Philip Fisher. It's a great, fabulous book.
Last one. Favorite CEO?
I'll go Angus Kelly, CEO of Air Kappa Airplane Leasing Company.
Jerry, who is it? Jensen. That guy, we've been following him for 10 years. He is so straightforward and honest. He has delivered on everything he says. It is a friggin' miracle to have owned that investment.
Good. Well, I will finish where I started by saying thank you to all of you for being here this evening. We'll stick around and do some socializing and asking other questions. It's been a wonderful evening. Thank you all for doing this. This is our first investor forum, and hopefully we'll do this annually. So thank you for being here.